In this video, I'm going to tell you the best UK consumer defensive stocks that you can add to your portfolios right now. Disclaimer, I'm not a financial advisor. If you seek financial advice, please see a licensed professional. Make sure to stay tuned to the end of the video, as I'm also going to be giving you a bonus stock. When investing in individual stocks and equities, it is very important to diversify. And so in this video, as I said, I'm going to talk about the consumer defensive stocks, as it is less cyclical than other stocks and will usually have a demand at most, if not all, times. Firstly on this list is Unilever. ULVR owns a wide range of products spanning from beauty and personal care, food and refreshments, and also home care. Currently, they have a dividend yield of 3.3% and a dividend frequency of quarterly, which is usually paid in March, June, September and December. Currently, they do have a payout ratio of 76%, which is very much on the high side, meaning that they can only reinvest less than 24% of their earnings back into the business. However, this is quite typical for a large, well-diversified company, as they have less growth potential than that of its peers. And because they are so expanded out globally, therefore they focus more on paying a high-quality dividend and growing it. And in fact, in the last 20 years, they've managed to grow their dividend year on year, except 2009, in which case it looks like a cut. However, I think this is just due to the conversion rates of currencies at the time from the change from pence to euro cents. However, the year after that, it had extreme growth. Over the last 10 years, they've managed to grow their dividend by an annual compound growth rate of 7.73%, which is nearly 4 times that the target for the Bank of England to be inflation, or for inflation to be set at. And if you'd have owned this stock in the last 5 years, you would have seen a return of 92.8% with dividends reinvested, which beats that of its industry of minus 1.6% and the market of 17.5%. Reckitt Benekiser sells health, hygiene and home care products. RB currently have a dividend yield of 2.85% and a dividend frequency of biannually, typically paying in May and September. They've currently got a payout ratio of minus 44%, which isn't good because this means that they are currently unprofitable. However, this is due to writing off 5 billion off the value of Mead Johnson, which is a company they had recently acquired in 2017. And this is due to the decline in the birth rate, meaning that less people need these sort of products. And so this is just due to writing that off, and I still think that their dividend is sustainable, and in the future this will be of little to no impact. With that in mind, in the last 20 years they've managed to consistently pay a dividend and grown it for 16 of the 20 years. And they've managed over the last 10 years to have an annual compound growth rate of 5.73%. Whilst which is lower than the stock mentioned earlier, it's still a good amount of growth to have year on year. And this is also taking into account the fact that they did not grow their dividend on some years. And in fact, this stock is very likely to continue paying its dividend in a recession, which is a time where you might need the income the most. If you'd have owned this stock in the last 5 years, you would have seen a return of 47.1%, with dividends reinvested, which beats its industry of 16.2%. The next stock is a SIN stock, which has arguably the most diverse and largest portfolio of spirits in the alcoholic beverage sector, having almost a monopoly and a very large moat, meaning that most competitors can't be in. Diageo has a current dividend yield of 2.5% and a dividend frequency of biannually, typically paying in October and April. They are boasting a respectable payout ratio of 54.4%, allowing them to continue growing their dividend year on year and also make further acquisitions and reinvesting their earnings back into the company. In fact, 54.4% is the amount of people watching this video right now that aren't subscribed. So if you're interested in my Ftse stock picks and my investment journey documented weekly, then please consider subscribing. Thank you. In fact, in the last 20 years, not only managed to pay their dividend, but grow it each and every year. And in fact, over the last 10 years, you would have seen a dividend growth rate of 6.62% compounded each year, which I believe to be the ideal amount of dividend growth. It doesn't mean that the company is maximizing their dividend by risking potential earnings. Instead, they are safe, secure, and consistent. It will consistently pay the dividend through tough times and continue to grow it, which is an excellent stock to diversify your portfolio. And if you'd have owned this stock in the last 5 years, you would have seen returns of 71.5%, which underperformed its market of 72.5% with dividends reinvested, which is interesting because I would consider this stock to be very much in a monopoly and I'm not really sure who it's comparing to. However, this still outperforms the market of 17.5% with dividends reinvested, so it is still a great staple defensive stock to own. If you pause the video right now and make your prediction for the bonus stock, I'd love to hear what your guesses are down in the comments below. The bonus stock in today's video has a dividend yield of 3.9% and a dividend frequency of biannually, which typically pay in November and July each year. This stock is Tesco. Whilst maintaining a rough dividend history, they have seen extreme earnings growth over the last few years. And whilst yes, they do have competitors of Aldi and Lidl clawing away at their market share, Tesco was the stock or company in the best position to deal with the pandemic and were the leaders at the forefront of adapting to it. Their deliveries have seen an increased demand, one of the first companies to introduce store policies to deal with that of the pandemic. Make sure to click the subscribe button as I'm going to be talking about the best consumer cyclical stocks to add to your portfolio and also be giving a stock analysis on Tesco in the future. Thank you for watching. I'm Osborne Foreman. Have a good day.